Earlier this week, folks, Redfin came out and shocked the market. They indicated that it is without question a buyer's market. They went as so far as creating a chart that showed buyer demand is now 500,000 short of supply. This buyer demand is something, obviously, at one rental at a time we have called all year. But most of you, if not all of you, have one question. How the heck did Redfin calculate buyer demand? Everybody gets how they got to supply, but is buyer demand just black magic? I told all of you in all of my comments, I will be asking Lance Lambert from Resi Club Housing to chime in and give us his thoughts. And oh, by the way, check him out on Fox Business, where he talked housing as well. Lance, you are everywhere. You are a star. Thank you for being here each week. We appreciate you.
Yeah, thank you for having me. Really appreciate it. And I'll jump right into this housing, and share my screen, and let's take a look at these charts.
Absolutely.
Let's see here. Can you see my screen?
I can. There you go.
Awesome. So here's the analysis from Redfin, and they show that during the pandemic, so during the lockdowns for like a month, few weeks, right, the number of active buyers fell way down and then just skyrocketed up, right? And so during the pandemic housing boom, there's a lot more buyers than there are what they call sellers. And then when rates shot up, the number of buyers in the market dramatically pulled back. The number of sellers inched up a bit, and then they kind of got into an equilibrium. And this is kind of like that, bit of a, tighter market in 2023, despite everybody in the second half of 2022 being so cautious, so bearish. Mm-hmm. And then really at some point over the past 18, 12 months, that dynamic has really started to shift, where the number of sellers is growing wider and the number of buyers really staying flat. And so sellers is taking all the active listings, all the listings in the market, plus also the new construction side of the market. And that's kind of what the sellers are. Now, the way that I do active listings is a bit different. I like to take actives and then like minus out pendings. And I'm just kind of looking at, what is on realtor.com, right? Essentially those active listings for sale that they track. And while that's not all the active listings in the market, it is a really great methodology because it's a replicated methodology over time. And so, yeah, even if it doesn't have, like it's missing some listings here or there, and maybe the new construction sector, given that it's the same methodology over time, there's a lot of value to using it, right? And so
consistency is key. I totally agree. Yes.
100%. Yeah. So I that's why, but that's just something to keep in mind if you're looking at like NARs, which doesn't take out pendings, or you look at realtor.coms, or if you look at Altos, which is just single family, all of those are going to be missing some active listings and some listings, right? There's always going to be some holes in the methodology, but given that they measure the same methodology consistently, there's a lot of value to it. And directionally, all of them have been showing the same thing. And they've been showing the same thing over various years in different directions. So like when the market is really tightening and heating up into the beginning of the pandemic housing boom, they're all showing active listings going down, and then recently showing them going up. And so how Redfin did this methodology is the number of sellers in the market is simply active listings, right? Like how I said. And then the number of buyers is they took active listings and pendings from the MLS to estimate what fraction of homes on the market sell within a given month. Mm. We estimate that the fraction of buyers on the market will find a home within a given month using realtor.com data on the typical home or from the typical time first tour to its purchase. The ratio of these two data points approximates the ratio to sellers in the market. Mm-hmm. We then multiplied that ratio by the number of active listings to get the estimated total number of buyers in the market.
Yeah.
Note that so essentially, if you're just tracking active listings and the shift in active listings, you're going to be able to figure all this out without actually using this methodology. If you use months of supply or use active listings, and then in the new construction market, if you're using completed unsold new builds, you'll be able to measure all this without trying to calculate how Redfin did the
Yeah.
number of sellers, the number of buyers. And generally, directionally, I think this is about right, right? The
Yeah.
number of buyers has been very pulled back and constrained for a bit here.
Yeah.
And that's been, true, since mortgage rates really shot up and we started to feel the real affordability punch from that big run up in home prices during the pandemic housing boom. But what we've seen, the longer we've stayed in this environment, is the amount of active inventory for sale has been building. And so even though the number of buyers hasn't pulled back harder necessarily, the longer we've stayed in this environment, active inventory is built. And so that power dynamic has moved more and more from sellers to buyers. And of course,
Yeah, there's no question. And again, we've been calling a buyer's market all year, and we have receipts to prove it. There's one thing that I have a problem with this chart. And again, it's really hard to do when you're looking at a macro environment like the entire United States. But I think we have to acknowledge that we have a broken housing market. And again, the broken housing market started way back when rates were kept too low for too long, refis, purchases, 2-3%. The housing market is broken. So what I would love to see someone do who has this kind of view is simply go in and divide the segment into above and below the median. Because I talk to agents, I look at data all the time, and
I'm seeing weakness through the whole thing.
Yeah,
I'm in this data deep.
Yeah.
There's weakness, like the narrative of like the 22, 23, it's shifted.
Okay.
And now I think that like a lot of the people you talk to that are like the California West, like those are a little bit different, but it's not the same story as it was in 23. And if you go into these Sunbelt markets in particular, where a lot of this entry level spec has been built, there's a lot of weakness at this entry level side of the market in some of these big new build markets, like deep out in the exurbs of Phoenix.
Oh, for sure.
Markets. Yeah. And so, but I think there was, there's like something to that, but I think it's also like there's been a shift there as well.
Yeah, because when I talk to agents across the country, and again, we'll focus on sellers first. Every market I've talked to, when you look at days on market below the median and days on market above the median, there's a noticeable difference. For example, we talked about Orange County yesterday with Adrian Hernandez. Below the median, I think was roughly like 48. And oh, by the way, that's up from last year, which was 28. So it's almost a double. So clearly weaker, to your point. But when you go above the median, it went from something like 43 to 80.
Yeah.
Right? Just much weaker. We're seeing much more inventory above, which makes sense. We see a bunch of buyers pull back.
It really does vary a lot across the country on that one.
I'm sure.
These new build markets, what they did is they chased that spec inventory.
Correct.
And they, the market was shifting under their feet and they didn't quite notice it as much as it had. And so they really went hard at that speculative entry level new build for the first time buyers. And I think there is something to that. It just kind of varies a lot across the country. And I think these heavy new construction markets in particular is where you're going to see that story maybe diverge more.
I think that's true because again, you look at the Sunbelt, Phoenix, Texas, Florida markets where they were building out in the exurbs entry level housing. That's now competing with existing homes, and that's just going to pull existing homes down as well because again, builders have proven to basically play the game of payment, right? Let me lower your rate, let me do this, let me do that. So I think new construction in those markets is likely a much better deal, which will eventually impact existing homes.
And I've gotten some interesting data proprietary from Zonda that showed as of right now, the builders themselves haven't seen as much competition from the rise in existing home inventory, even though it's gone up a lot. But where they're seeing the real competition for the builders is against themselves, right? That unsold spec inventory, right?
Okay.
Now, what's kind of interesting is that like if you zoom out, there's always like that narrative of home builders compete against the existing home inventory, right? Or the where the builders can really get in a pickle if existing home inventory is up, right? Well, what we're seeing more so in this market in particular is that new home construction is really competition for the existing home seller, right?
Correct.
And so
Correct.
all of that unsold entry level speculative new builds, right, is really, that's really shifted and cooled the existing home market, right? And so if you're in those parts of the country that has a lot of that unsold new construction inventory, that's really weakened that existing home market more and driven up their active listings in the existing market. And so even in Florida, only 15% of home builders say that existing home inventory is significant competition right now for them. Even though they're weakening and the market has softened a lot, their biggest competition is still the new builds, right?
Yeah. So let's step back into the main conversation that Redfin is really putting out there, and I think both you and I agree with. We are now in a buyer's market. Buyers, generally speaking, have more power across the country than they have before. Any thoughts on that conversation? How long it might last? It certainly seems to have legs and momentum.
Yeah. So directionally, buyers have gained power. Let me see if I can find. So here's active listings in the U.S. We just got the print for end of May that just came out.
Ooh, look at that.
It takes us to over 1 million for active listings in the Realtor.com data series, versus the same time last year we had just under 800,000, 790,000 ish. And so active listings is rising, and that continues to tell us that directionally buyers are gaining power. Now, I think there's still, some of those pockets of the country where, sellers still have more power, right? Some of these Northeast pockets, some of these Midwest pockets, but directionally speaking, across the country, we've seen the softening where buyers, relatively speaking, have gained more power. And if you go into some of these parts of Florida, Texas, Arizona, Alabama, North Carolina, and it's even more growing to be more of a case in pockets of California as well, they're solid buyers markets, right? And in some pockets of, some pockets of Texas, and then some pockets of Florida, they moved into corrections. And so it looks like Miami's market is in correction mode. Initially, the correction there had started in the condominium market, but it's now spreading into single family, rolling over. And month over month, home prices for their latest print were down like 1%. And that's down 1% and that's not seasonally adjusted. So if you hear a lot of these numbers out there online about like half the states in the country are falling right now, that's with a seasonal adjustment, right? So without seasonal adjustment, most markets still saw a little uptick this spring, and so when you seasonally adjust it, that's when they go down as much. But Miami's market didn't even need the seasonal adjustment. Just without adjustment, they just did an outright decline through the spring selling season. And so, there's some real weakness there that buyers and sellers can go out and find probably even better deals as we go into the second half of the year. Because right now we're passing through the seasonally stronger, quote unquote, window, right?
Correct.
Where there's a bit of that seasonal uplift. Historically what happens is that the number of new listings starts to rise going into spring, and then existing home sales start to rise going into spring. And then that's followed by the most upward pressure seasonal or through the year, seasonally speaking, for prices, right? They go 1, 2, 3 is how they usually do it in the data. But this year, what we've seen is that uptick there for prices has just been very soft. And so what that suggests is in more of the markets where it's been very soft, there will be more give up for prices into the second half of the year. And one more thing, because I don't want to lose the thought here, is the key thing to watch is going to be active inventory, because active inventory, when that begins to firm up, right? And firm up in terms of like it starts to go back to moving with the seasonal trend, that's going to tell us what will happen in terms of the shifts in the power dynamics on pricing. So if we start to see that firm up, it will lead what will be a later firming up on the selling dynamics between buyers and sellers.
So when you say firming up, just so people can look at this chart, because again, you put it out so often for us, which we appreciate. Firming up to you means kind of rolling over as we get to the end of the year, looking at 17 and 18.
Over. You actually can't even see it on this chart. So I have another way that I measure this that I don't share. And what it pretty much does, and maybe I could just do it in the spreadsheet to show you kind of how I think through this data. Give me a second here. Let me see where I have it. And we are, okay. So here's how I do it so this is May. Okay.
Okay, so you get the delta.
Yeah. So between 2018, between 2017 and 19, typically active listings at a national level went up 51,000.
I got you.
And we're going up 77,000.
Ah, right? Got it. Okay. Yep.
Last year was a little bit closer to that, but then it shifted more. And then this year we kind of saw more acceleration. Let me see what it was for the previous month window we saw. Yeah. See,
much higher again. Yep.
Yeah. So, I mean, that's not as big of a separation this month as it was the previous one. Like, that's a really big one.
Yep.
So I think if we start to see active inventory, right, rising closer to that norm, like if we see a normalization in active listings and then we begin to grow closer back to the 2018, 2019 trajectory, right?
Gotcha. Yep.
On a month over month basis. And so it's not just about the rolling over, it's about like the speed of that rollover.
Very, very cool insight. Thank you for that.
Yeah. So that's kind of how I think about it. And right now, when you're growing at this rate, given, what the normal seasonal trend is, that suggests, a softening, right? And so if you look at these prints here, it's actually very interesting. So 17 is up 55,000 between April and May.
Yep.
2018 is up 55,000, essentially about the same. Then 2019, it's 43,000, so a little less, which actually kind of suggests that the market is kind of tightening, right? 2020, that's down 13,000.
Negative.
I would say that is a mulligan print. Because what occurred is we saw that drop in like the market was just in shock in April 20.
We shut the country down. Yeah, of course. Yeah.
So ignore that print. But it is, worthwhile because later in the year we continued to fall, right? As the market heated up. So it ended up mattering. And then here's the one where it's really, this is not good. Between April 2021 and May 2021. So in that spring 2021 market, that month over month was only 12,000 listings.
Yeah. Yep.
Then the next year was the rate shock. And so it jumped almost 100,000 in a month. And that's like, wow, that really spooked the market, right?
I remember.
And then the next year we're plus 19,000. So the market's like, whoa, maybe the market isn't going to soften here as much, right? And then what we started to see is over time, we kind of, yes, there was that initial rate shock, but the trajectory ended up continuing to a softening of buyers gaining power. And 24 was kind of closer to normal. And then this year, the bigger lift.
Yeah.
And so I think that's what I would suggest watching is a leading indicator, is when do your months of supply, right, start to normalize on a year-over-year basis? When does your growth in active inventory start to, stabilize on a year-over-year basis? And so I would watch active inventory growth.
Love it. You put in so much effort with all the stuff you do at Resi Club. Where can people go get and sign up for your free articles and maybe check out the data behind all of this amazing stuff?
Yeah. So if you want to read my content, go to resiclubanalytics.com. You'll be able to see a lot of my recent and past stories. You put in your email, you'll be signed up to the free list. And then I also have a premium offering called Resi Club Pro that readers get more research access to my data. And then, my email also is Lance@Resi Club Analytics if you ever have any questions with the data.
Wow, he gave you his email. That's not normal. Lance at Resi Club. Is it ResiClubAnalytics.com?
Yep, that's right.
There you go. Thank you, Lance. Take care.
Thanks, Uber.